As 2025 moves rapidly through its first month of the new year, there's certainly no shortage of important market events for investors to consider. So we'll just list a few. Of course, we have a new president that was sworn in. The quarterly ritual of earnings reports is underway as companies report fourth quarter 2024 financial results. And this week, the Commerce Department is set to report fourth quarter gross domestic product, and the U.S. Federal Reserve Bank will meet to address and comment on its short-term interest rate policy. Most recently, news from China about a new low-cost, power-efficient generative AI, artificial intelligence, or GenAI engine has perhaps disrupted the competitive landscape in the emerging GenAI technology space. So I'm going to spend a few minutes on two of these market factors. The first is a view that Trump administration policies have unleashed animal spirits that can drive equity markets higher in 2025. And the second is the potential for disappointment, though, when expectations and valuations are high. The discussion of animal spirits was developed by British economist John Maynard Keynes in the 1930s. It's often used to describe how human emotion can drive asset prices, especially the stock market, higher. But more accurately, Keynes applied his animal spirits to economic trends, as he believed that emotion could be a meaningful driver of unexpected positive economic activity. And although it's very early in Trump's new term, since the November election, consumer confidence surveys have risen and surveys of business optimism have surged. And this is related to expectations for lower regulation, lower taxes, and an overall pro-business environment. It remains to be seen how this might translate into economic growth, but pro-growth sentiment has contributed to broad-based equity gains in January, and in fact, 10 of 11 of the S&P 500's macro industry sectors are positive in January through the 27th. And the one negative sector, perhaps surprisingly, is technology. And this leads to our second point of discussion, as elevated equity market valuations like we have today reflect high expectations. The S&P 500 trades at more than 22 times estimated 2025 earnings, which is the price to earnings or PE ratio, which is a 20% premium to the average PE ratio over the past 10 years. In today's market, this means that investors expect the U.S. economy to grow above trend, inflation to trend lower, and corporate earnings growth to accelerate. Each of these are factors that appear underway. However, this leaves a very small margin for error, and disappointments in any one of these expectations can erode investor confidence. And this happened this week when the China GenAI disruption news caused a steep sell-off in many semiconductor, data center, and power generation stocks. While the potential disruption remains early days, this could be the beginning signs of a leadership rotation, both within the GenAI technology space and perhaps across the broader equity market. This market action further supports our investment strategy to avoid becoming over-concentrated in a narrow segment of the market and remain broadly diversified. While the big picture remains supportive of equity market gains in our view, beware of overly aggressive expectations and build more balanced exposure across sectors and industries. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.